let me now introduce my panelists for this session. We are blessed today to have a very eminent panel of experts in this investment domain joining us today. So ladies and gentlemen, it's my privilege to introduce each of them one by one. Let me start with Dr. Qasim. Dr. Qasim is the Senior Director of Private Banking at Emirates Islamic Bank in Dubai. So he is a veteran investment banking professional and a private banker with nearly 3 decades of experience in different markets across the globe. He's been with top banks in Germany and in Switzerland and has been in Dubai since 2015, heading this department for the bank. He's got a PhD in finance from USA and is an eminent scholar and an investment professional who has a great achievement to his credit. So please join me in welcoming Dr. Qasim for this discussion.
Thank you, Doctor.
Ladies and gentlemen, now let me introduce my next panelist, Muhammad Ali Yassin. He is the Chief Strategy Officer and Head of Client Relations at Al Dhabi Capital in Abu Dhabi. He joined Al Dhabi Capital in 2018 as the Chief Strategy Officer. Before that, he was the CEO of Fab Securities, one of the largest securities company in UAE. He's got nearly 3 decades of investment experience and has been associated with a large number of companies in the region, like Shua Capital, Emirates Securities, and all this. He is a council member of the ESCA's Commodities and Investment Advisory Board, and is a consultant to their CISI and the other exams. He holds a degree in computer science and maths from the University of London, and is a seasoned investment professional whom you can all mostly find on Bloomberg. And yesterday his very pertinent remark on Bloomberg was a point of discussion in the investment circles. Welcome, Mr. Muhammad Yassin.
Thank you, Doctor. Thank you all. Looking forward to this.
Thank you. Ladies and gentlemen, my next panelist today is Mr. Deepak Mehra. Mr. Deepak Mehra is again a very seasoned investment professional. He is currently the Head of Investments Global Markets at Commercial Bank of Dubai. He is an investment veteran with close to 30 years of experience in this domain, spanning across the globe. He's had an illustrious career in senior management roles with Credit Suisse, Citibank, and erstwhile Dubai Bank before the current role with the Commercial Bank of Dubai. A very interesting point about Mr. Deepak is that he is a renowned author. He's an author of a best-selling book, Ready, Steady, Go. It's nothing to do with the markets, but it's a book about your career, how you progress in your career, and how you prepare for a very disruptive future. Ladies and gentlemen, it's my privilege to welcome Mr. Deepak to this panel discussion. Thank you.
Thank you, Dr. Allen. I'm honored. Thank you.
Thank you. Ladies and gentlemen, the last but the most important among all, the speaker is Dr. Mark Nassif. Dr. Mark is the Managing Director of Awad Capital, an investment banking firm in Dubai focused on mergers and acquisitions, venture capital, and technology-related domain. He's a veteran investment banking professional with over 2 decades of investment experience across the globe. Prior to his current role, he was the Head of Markets and Clients and Financial Advisory for Deloitte in UAE for a period of 7 years, where he had very commendable achievements to his credit. Dr. Mark has a PhD in finance with a very pertinent specialization in corporate finance focused on valuations, and he studied the valuations of the e-commerce companies, and it's a very unique research to his credit. So ladies and gentlemen, my privilege to welcome Dr. Mark to this session.
Thank you, Dr. Allen. It's a pleasure.
Thank you. So once again, good morning, good afternoon, everyone, and let's get going. So now, as we start, let me just set some of the ground rules of our discussion and make it very clear to all of you, because we understand that people from different business functions, from the investment domain, from credit, from corporate banking, from insurance industry, and a lot of other professionals across the world are today joining us. So it's very important that we set a common tone of our discussion. We will try to keep our discussions as non-technical as possible. We'll try to make it simple so that everyone can understand. And wherever we ask a question, we would try to set a context to it so that even if you've not been following the topic, you would at least get a basic idea of this. So now, as I start, let me start with the most important question, which is definitely there in all your minds. It's about the economy. It's ultimately all about economy. So investments are a subject matter of, the performance of the economy, in the long term. In short term, markets can be rational or irrational, Now, I think it's very wise on our part to get the inputs from our eminent panel about what they think about economy. We've had a massive, a massive impact of a lockdown across the world, and the world is literally headed to a recession. There's no point discussing much about the past. Everyone knows what happened and what's happening now. I think what we need to hear from them is, what do you think about the economic recovery ahead? When do you see it coming? Do you see it coming after all? And do you see it coming quick? Do you see a V-shaped recovery, which is a very fast and quick recovery? Or you see a U-shaped recovery, which could take a very long time? Or could it even be an L-shaped recovery where it could go on for years and years? So now, ladies and gentlemen, my privilege to ask my panelists, can I start with Mr. Mohammad Yassin, for his quick inputs on board the economy? Then we would go into different asset classes one by one. Yes.
Thank you very much. You start with the most general and the longest answer question for all. I think to try to summarize, of course, one of the things that came out from what we saw with the COVID, this crisis, is one thing is that everybody agrees that the capital markets today very much don't reflect what the economies are. That's one disconnect that happened that wasn't there before. And the reason is those capital markets today have been supported heavily by monetary policy, policy support from central banks. So we saw that the Fed and the US, over more than $8 trillion of support came into credit markets, into the bond markets, into supporting the repos and things like that. And that has ensured that today that we saw that the capital markets, so the equity markets in particular and the bond markets, are actually today higher than when before the crisis happened. We saw the market go down 40% and come back. By yesterday, it was up like 42%. So that's one idea that we have out of this crisis that came to mind. Two, we definitely have changes. I don't think in our lifetime, and I may be the youngest of the panelists, but I'll take that risk and say we haven't seen a way where the economies have come completely to a halt. Everybody talks about the depressions of the 1920s, but to see economies and countries completely come to a halt for a period of time, especially in mid-March to April, that is something that has been unforeseen. And the effects of that, the effects of letting people work from home partially, the fact of a lot of these businesses completely go from activity of X goes down by 80 and 90%, that hasn't been seen, and that recovery is not there yet. So that is still a challenge to come. In doing all of this, the government roles in trying to support these economies has varied from one place to the other. So we saw central banks, as we said, come in, so they supported the markets, they supported the banks, but they cannot really recover the economies. They just buy the economies companies time to recover. However, what I believe is that today, this recovery, these government's roles have been various from one country to the other. Some have been very well. You could highlight places like, for example, Germany, and that's a success story, I think. And there are some areas in the GCC where we'd like some more to come because we think that you have stabilized the banks, but probably not supported the rest of the SMEs. If you don't mind, I'll just stop here and leave that.
Sure, please. And I think we have a lot more to discuss. Many of these points can be covered when we talk about the asset classes. Can I now ask, Mr. Deepak for his views, quick views about the economy, and we'll talk about asset classes later.
Yes, of course. So I think what has happened so far is very well known to all of us. what is not so evident and what's not getting so much of coverage in the media is the recovery, which is visible in the high frequency data, not so much in the data which is published by government agencies. So the data looks, the headline data being published in newspapers and media and television looks very bad, and it will look even worse in the coming couple of quarters. So that's no surprise. That's well known to all of us. I think what has caught people by surprise is how strong the human nature continues to prevail and how quickly people want to get back on their feet and get out and about. And that is visible in the high frequency data. And that is something we'll discuss later on in the discussion. The other point I would like to highlight in the beginning is from a long-term perspective, there have been many mega trends, mega economic trends, which have been already in play. Whether it is the technology development, whether it is the peaking of global growth opportunities, global growth rates, peaking of global population rates, and hence peaking of the global inflation and interest rates long back. And so for the last 40 years or so, we have been seeing drop in interest rates, drop in inflation, drop in growth rates. What COVID has probably done has accelerated those mega trends which already exist. And so that's the long-term view. Thank you.
Thank you. Dr. Mark, can you come in with your views about the economy and the road ahead for the economy?
Of course, and I totally agree with Mohammed and Deepak. I'm not an economist by trade, of course. But what I know is that nobody knows what's going to happen. I think there are still a lot of unknown unknowns. Things are, moving on sometimes on a daily basis. And if you see the markets, they go up and down with just a few bits of information about a vaccine being developed or a little bit of advance in a vaccine being developed or a cure being a little bit more advanced than others. So I think the markets are very thirsty for things to get back to normal, of course, but they've been, fed by the Fed, excuse the pun, with free money and. But from an economic perspective, I think there's still, as I said, still a lot of unknowns. Nobody knows what's going to happen next week or next month or next 3 months. So I think it's still too early to make a call.
Sure. Thank you. That's the honest and fair remark. Over to Dr. Qasim. Dr. Qasim, can you share your views about economy? None of us are economists in this panel, but again, investors share the perception that we track the economy very closely. So I think it's important to get everyone's views.
Thank you, Dr. Allen. Thank you, gentlemen, for your feedback. I think to come a little bit back about figures, data is important. And if we make a small analysis about what happened since the beginning of the year, if I look into figures, just in the last week, we have a recovery of the equity markets. We have a recovery even of the real estate indices, between real estate indices plus 10% in just 1 week. We have the emerging markets, MIC, even MIC World coming up in 5 to 7% on average. And you see very well that, for example, gold, which has been performed during this year plus 11%, is losing in the last couple of weeks, and especially in the last week of approximately 2 to 3%. So I agree with Mark, we don't know what's going on. And I think in this market, we have to go a little bit with the Chinese philosophy, because everything comes there. It's a discussion about who will lead the world, who leads the business in the future. And there is the famous Chinese philosophy person who was Confucius, and he said very important, and I think everybody should think about this sentence: he who knows all the answers has not been asked all the questions. And I think here we should continue with Dr. Allen and the next panel.
Sure. Thank you so much. So thanks for your input. Now, I think it's time for us to move into different asset classes. So we will look at different asset classes. We'll look at different investment options that many of you are considering for your professional, personal, interest. Before that, we will have a very short poll. You would have a poll appearing on your screen very shortly. So you would be asked some questions about where do you want to invest, if at all you're looking to invest, I hope you don't hear an answer that I don't have money to invest, So you'll have a poll on your screen very shortly. We'll give you a minute to answer the poll. We'll ask you different investment options, and you can answer that, and then we would take the discussion forward. Yes.
Everyone, the poll is on. People are voting. We have 1 minute for all of you to vote. Please do the voting. Thank you. We have launched the poll results. As all of you may be seeing, we have, for example, almost 70% of our participants sharing their votes. And you can see, for example, two interesting domains. One is with the fixed income part. There is a 26% inclination. So where do you invest your hard-earned money? Which asset class? So most of the hard-earned money comes within the fixed income domain. We have then the real estate coming in 25%. And one of the interesting part is we have 11% sharing that they don't invest. I don't invest at all. So there are different perspectives in front of us. Over to you, Dr. Alan.
What percentage is sharing a view on equity? I can't see this poll myself.
Yes, so equity, it is 18%.
Okay. So it's almost evenly spread, so there's no heavy inclination towards any particular asset class, it looks like. So it's good, we have a mix of, investment professionals and investors here. So who are open to looking at all the asset classes. So I think it's important for us to start with, I would say, the most attractive asset class ever. I am a professor of investment, so always I have an inclination towards equity as the best asset class in the long term. There's no other asset class which is performed like equity in the long run. So obviously there are volatilities in the middle, but definitely equity has created wealth for investors. And in this era of very low interest rates, where you hardly have any place to hide, where you see real estate markets, heading south, rental yields falling, I think probably equity investment continues to be one of the most attractive asset class, equity-related asset class, as far as investors are concerned. So now let's start with equity. So we will take our panelists' views about equity markets, and then we would, proceed to the next asset class. So let me start with my first question. Let's start looking at what's happening to equity. Let's start with the biggest of all the markets, the US markets. It's been really surprising. It has really taken the whole investment world by surprise. The pace of the crash in March was the biggest surprise. We had the fastest ever bear market in history, where in 19 days sharp, we lost 30%. And I found many investors on Twitter and all this channel saying, let's close down the market. If it goes like this in another 2 months, it'll be down to zero. So that was the fear on the street a month back. And now what's happening? Yesterday, the markets have touched again, close to all-time highs. So what's happening in US market is quite, surprising. People are swinging from fear to greed in a matter of, no time. Now, what's the road ahead? What has happened to these US markets and what's the road ahead is something we will discuss. Gentlemen, who can take my question first? Dr. Kasim, can you come in? I think you cover the private segment. Yes, please.
Yes, thank you. If you have seen already, if you compare a little bit what happened in the markets, as you said, the markets went down in March and it's now going up again for the simple reason there is a lot of liquidity which needs to be placed, and the Federal Reserve Bank in the US is pumping money into the market which needs to be invested, being it in the treasury bills, being it in the equity markets. It's also political. We have to see that Trump wants to be re-elected and he has to show a very stable and good economic situation in his country. And I'm not surprised, and I think it will continue with these markets, but it will be volatile. And that is, I think, the opportunities where most investors in the equity part can take a bite on. I think if you look even at the Chinese markets who went down, recovered, if you look, for example, Japanese markets, Asian markets, who fall down between 60 to 80%, already recovered those 60 to 70%, the same which happened in the US. So I think we will see another drop for sure. Some sectors will lose performances, but there are a lot of stocks or opportunities where you have a deep look, because you can use them as a trade opportunity or as a long-term investment. I'll give an example. For example, Boeing. Boeing before was about 400. Now you can buy it at 100. But Boeing is not only producing airplanes, it's also in other sectors active. And it pays dividend, while a lot of other stocks who are performing not giving you any dividends or income. That's just a small idea about that.
Okay. Thank you, Dr. Qasim. Can Mr. Mohammed come in on a regional market perspective? We've had it's not a bear market here. It's not something that has happened in 2020. It's going on for the last few years. So now, what's the outlook for this region and especially the UAE markets?
Thank you, Dr. Yeah, and let me just comment on something that Dr. Qasim said. Somebody was saying about the US markets, it went from depression, from recession to depression to recovery in less than 100 days. That tells you what the equity market were giving you as a signals. And therefore, today, if you are a fundamental kind of analyst, a fundamental investor who are looking for the long term, you look for the profits, you would not be in the market in many of those stocks other than tech stocks. There are about 7 or 9 tech stocks, you know them, they are the ones who are carrying the index there in the US, and those are the ones that are giving you the indication of a positive market. If you are in some of the other ones, there is a recovery that started, catch-up story, but it just happened last 2 weeks, but nothing that impressive. Therefore, what I'm trying to say here is that to take us to our markets here, what's driving the markets today is the liquidity. It's a sentiment issue rather than a fundamental issue. If you want to look at the fundamentals today, closing businesses is not good for fundamentals, is not good for profits, is not good for growth of companies. Many of the companies, if we are in the region here, if we focus on the region, the main big caps we have are the banks, we have the real estates, and we have the telcos, mostly. Maybe in places like Saudi, we have some consumer also spending companies which have some weight and insurance. Banks today, without the support of the governments, they will not be able to be where they are and continue working as well. So banks, the central banks went and gave liquidity to banks to be able to continue, and they have asked them also to delay kind of their fees. So their fee business has been shifted forward for 3 months or 6 months, which is not good for them. And the liquidity now, they're taking it from government. There's a cost. It's not all for free, it's some of it for a cost. So today to talk about and there are a lot of provisions and impairments, and we heard about lots of the stories of companies failing also. So all of these today makes it a very tough environment for these companies to show profits higher than last year's profits. And therefore, we today, if you look today at some of the share prices, we have seen some of our markets go down close to 30%, but they've recovered now about half of that based on kind of support by the government, some of their semi-government institutions buying into those markets. We saw a recovery. We are in the region, are very close to oil, so we saw the recovery of oil that also have helped. But overall, I think for the region, It's today now in the equity markets, it's a case of preserving your cash, if you want, or your investments, rather than actually looking for a huge growth coming from the fundamentals. If the sentiment improves now with the opening of those economies, then maybe by September, October, we could see some kind of that reflecting or flowing into the equity markets, and we see some improvements.
Thank you for those views. Yes, please.
Something to what Mohammed and Qasim said. I agree with, of course, with Mohammed about the technology stocks. So obviously now most of the, especially if you take into account, of course, Nasdaq and S&P, they are the technology stocks. The weight of technology stocks is very high. So that's why actually they are also carrying up the indices. Because as you have seen as of late, the last 3-4 months, we've seen that technology has been the biggest winner out of this crisis. And even before the crisis, if you look at the six of the largest technology companies in the US, the market cap of what's called FanMag. So you have Facebook, Amazon, Netflix, Microsoft, Apple, and Google, which is Alphabet. The market cap of these 6 companies were bigger than every single market cap of all other countries, except the US, of course. That was even before the crisis. So I assume now, I don't have the latest figure, but if you make the comparison now, I think it would be even bigger because they've been the real winners out of this crisis.
It's even bigger than the GDP of many large-sized economies.
Yeah, of course, yeah, bigger than the GDP of Germany and France and the UK by a big margin.
Sure. Mr. Deepak, do you have any specific views to share about what could be the road ahead for the stock markets here from a regional or global perspective?
I think the panelists have given us a brilliant overview, and yeah, there are sectors which are going to do better than others. There are few stocks that have been driving the headline indices higher. But my view is that equity markets in general try to discount the future rather than react to what has happened in the past. So, that's the psychology of equity investors. In that case, they start looking at, will there be a recovery or not? Rather than worrying about how bad the fall was. And so that's the psychology, and that is being supported by the money being printed by central banks. But money alone cannot lead to stock market gains unless the investor sentiment is positive. Investor sentiments in equity markets are generally forward-looking. So I think that is the fundamental premise on which stock markets work.
Thank you for Deepak. I would like to add something here. If you just compare a couple of stocks, even in the car industry, if you see a Tesla has the same market capitalization like a Volkswagen, a Ford, or GM together, and all of them don't give you any dividends. If you want to invest, you have always to look at the PE ratio and what does it give you a dividend. And if you take companies like in Japan, like a Toyota, it gives you at least at the moment 3.5% as a dividend yield. So I think it's very important to look at PE ratios about the forecast of what kind of dividends those companies gives you. And based on that, you make your pricing, because you buy today a Google or you buy today a Tesla, it will not give you anything in the moment. It is just based on growth expectations.
I think that's a very good point. Yes.
Yes. So I think in this context, I think we can take this point also here as to what are the futuristic sectors that probably we should look at investing. No? Since we're talking about equities, I think it's important that we talk about that as well. So today we are hosting this webinar on the Zoom platform. The market cap of Zoom has literally zoomed. Sometime back when I read the market cap of Zoom was bigger than the market cap of all American airlines put together, one of the most asset heavy industry in the world. So now some of the new age businesses, that just came out, have disrupted the market, are probably going to drive the future. So I would like to get your views on behalf of all my participants who've joined as to what are those sectors that as an investor that I can look at. If you can share your brief views about the futuristic areas of sectors that equity investors can look at. Yes, gentlemen, you can comment.
Shall I start?
Yes, please.
Yeah, of course. I mean, being a technology investment banker, so I think that definitely for me, technology is the most important one. And as you rightly said, Zoom has been doing fantastically well. And also, as I mentioned, if you think about Amazon, about Facebook, about all the others, Google, all of them, they are doing extremely well. But this is not the only thing, this is not, sorry, the only companies that are doing well. Or if you look at the technology sector, it's definitely now being very wide. Technology used to be very focused or very kind of a vertical. Now technology is more horizontal. So you have technology in each and every sector. In healthcare, you have health tech, you have edutech for education, you have legal tech for any legal services and firms. So technology has been, has moved from being more of vertical to a horizontal. But obviously, technology companies will be the big winners for the long term. Because if you think about e-commerce, people who have been buying now online groceries, and they found that the customer service is good, it's very easy, very convenient, they will not go back to take a trolley and go buy from Carrefour or from Union Co-op anymore. They will continue doing their online shopping, of course. If you think about health tech, again, now with everything going on, healthcare is the most important sector, trying to find a cure or a vaccine for COVID-19. Again, it will be one of the biggest winners, especially if you think about the telehealth, which is, you know, you don't need to go each and every day. You just have a cough to go and visit the emergency or have a doctor appointment. So you can do it online over the phone, and it's much cheaper for you and much more efficient. If you think also from a regional perspective, what we have found out is that the government also has been, over the last few weeks and months, they've been very keen on encouraging everything that is produced locally. So if you think about agri-tech, Abu Dhabi, through Abu Dhabi Investment Office, they have invested more than $100 million in 5 different agri-tech companies because they want to grow the sector within the country, and you don't need to go and buy, I mean, cherry tomatoes that have been grown in Holland, and you pay them 3 times more than what you can pay here.
So it's all about technology, you know.
It's all about technology.
Yeah, so I think it's a very interesting, perspective, and I think the future after this big disruption, I think most of us would agree on this panel that it's the tech sector that one should look into. But then comes the next big question: is everything a good buy at this price? Are valuations not important? Can we get some perspectives on that? I'm getting some questions also from the participants. One interesting question that I can share with the panelists: what is the investment strategy that you should do now? Is it time to buy long term? What Warren Buffett said: buy when everybody is fearful, and sell when everyone is greedy. Is it time to be greedy and say, it's good time to buy long term? Or is it just time to take profits every now and then, stay safe, go back to cash wherever possible and protect your profits? So what do you think is the best investment strategy now for equity investors? I think it's a very important point that we would love to hear your feedback. Gentlemen, can you come on these points?
Allow me to jump in quickly. And
Sure.
I think the question should be not only to jump into equities now or to jump into gold trading or in this one. I think the question should be, how can I build up a portfolio which should be diversified? I think based on the risk class of each individual investor, the investor who's 20 years has a different risk profile like somebody who's 30 or 50 or 70. And I think it's very important that we start with investors first to see what kind of asset class he should, and in case he is deciding to have 10-20% of equities, I think that is the right way. Our panelist mentioned, like Mark, the tech sector, the education sector, the online sector, the healthcare sector. Yes, that is the future, and that will continue for sure. I will leave the floor for my friends Mohammed and Deepak and Mark as well.
Can I just come in on those questions?
Please, Mr. Mohammed.
I think all are important. The points raised by my colleagues are important. I think the question here for when somebody comes to tell you is it the right time to invest, is we need to ask him, what is your investment horizon? Today, that's one important question that decides what kind of how do you form a portfolio. But let me be a bit also critical and a bit honest from personal experience. In a crisis like what happened in March, they actually have exposed a lot of what we call the diversification of portfolios to be weak, because what I've noticed is that anything outside the public markets, you could not find a bid and ask within a tight range which is acceptable to what you were before the crisis. And let me here go to the fixed income part, and in particularly in the region. I'm sure Mr. Deepak and Mr. Qasim can, that they sell this every day. When the crisis started, if you went for the sovereigns, probably some of the governments were good, but some of the others in the GCC, like the Omans, like the Bahrains, the spread started, they dropped like from 100 down to 86. If you went for some of the perpetuals of the banks in UAE, they went from somewhere around 100 now to 92. And if you wanted to, they would give you an indication of the price market 98, you want to sell, go down to 92, and you will not find a buyer. So today, it's very important for the investor when he comes in today to ensure, one, is this liquidity that he needs immediately to exit off? Is he a long-term investor, or is he kind of a jittery kind of investor? Because that's going to decide what asset class you go into. Another point I would like to raise also is the issue of taking leverage or margin on your investments. Be very careful on doing that, especially in this time at the moment, because I think although the cost of borrowing by the Fed and the dollar is near zero, the banks have not dropped that to zero. If anything, some of the banks have actually raised their spreads to increase their net interest margins because of liquidity crunch in some areas. So there are a lot of elements that you as an investor sitting watching the screen or looking at the equities does not tell you the full story. In terms of picking some of the stocks and the sectors, I would love some of the things that were talked about by Mark are good if you are an international market. So US, you maybe go even to China. Europe a little bit now, there could be a recovery story. But we don't have these kind of companies in the UAE, in the GCC markets listed, unless you have a private equity account or you are part of a fund which does these things. It's very difficult to access those kind of things. So today you come here and you look into our markets. What I would suggest is be very prudent in your choices. Don't go after just the big names. I mean, today the big 7 or 8 that Mark has talked about, if you're going to go and buy Amazon at a valuation of $1.4 trillion, good luck to you. But what you should be looking for is where is the next Amazon? Where could be the next company that could be taken by Amazon? Because these kind of big deals, it's very difficult for you to be able to access them or to be part of them at the time. And honestly, if I would come into there's a saying in the US that say never fight the Fed, because whenever the Fed is pumping the money, and the Fed yesterday came and said, we're not increasing rates till 2022. I'm sure Mr. Deepak can tell us what effect has that on the curve of the fixed income on the treasuries, and how will that affect your investment? And I'll leave it on that.
Sure, Mr. Deepak, can you come in? Yes. You're muted.
Yeah, I was muted by somebody. Yeah. Okay. Thank you. I think the points made by Mohammed are very, very valid. And I think before we come to the fixed income and treasury yields, I will go back to what Mohammed just said before that. It's very important to align our objectives. And I would add to that the risk profile before we decide where to invest in the equity markets. Now, if you look at in the US, about 85% of all equity investment comes through institutional investors. Individuals don't go by picking stocks very often, unless they are ultra high net worth individuals. So when we are talking to our private clients or our priority clients and high net worth clients in the region, what we've been suggesting is that you have to be globally diversified. There is no point having a home bias. It's good to have a bit of home bias, but have a global diversification, number one. Number two, always go with professionally managed portfolios, because even though we know that technology is doing well, how do I know which technology stocks to focus on? Unless I stop my work and just become an equity trader. Most of the clients don't do that. They have businesses to run. Equity investment cannot be a sideshow. It cannot be a hobby. So second thing is, yes, go with the professional investment route. The third thing we have learned over a period of time is that passive investment is a great way to invest in market. Passive investment means through exchange traded funds, ETFs, that have very, very low cost, and they track the index. So if I pick up the index of internet stocks, I will buy an ETF which invests only in the internet stocks, and I will get exposure to all of them in a diversified manner. So these are a few of the pointers that I would like to leave behind when investing in equity markets.
Yeah, sure. I think one added discussion in line with our discussion here is one of the biggest challenges that most people faced in March was the kind of drawdown that happened. We saw a massive crash in the markets. So most people who spoke to me, they wanted to know as to how do you protect your portfolio against these kind of risks. So what strategies can you use? Is diversification the only option? Of course, we would always say, we have to be diversified across asset classes, across markets. But are there any other better options, like, even going for equity derivative options, like probably buying some of the put options or taking a futures position? So I would like to know the opinion of the panel as to what investors, could be individual or institutional investors, can do when it comes to protecting the portfolio. Because no one can say, whether the next month again we're going to see a similar cycle like what happened in March. It can happen. So how do you protect yourself till this volatility is over? Yes,
I think to have a quick summary how you can protect yourself, I think there are in our business at least 6 strategies where I can protect myself. The first is the diversification we mentioned. The second would be a non-correlating asset, which we'll go later into details. Of course, the put options you mentioned, Dr. Allen, is of course an alternative as well. We have to work with some stop loss limits, and of course, to diversify in some stocks who have dividends, and of course, in some protected notes, is also a way of protecting myself of a downtrend. I think the details we should discuss with my friends as well, but I think the 6 strategies are important to have in place. There should be not one strategy in place. It is a combination of all these 6 strategies in one portfolio. Is it the ETF? Is it the professional managed fund? Is it the excellent risk strategy of an asset management firm who is running a balanced or a growth or an income portfolio? I will give up to my friends Mohammed and Mark.
These are very, very insightful points. And I think those 6 strategies, I think it adds a lot of value. I hope everyone heard those points, from diversification to protecting your portfolio, to investing in non-correlated assets, to investing in assets that yield returns. I think it's a great time to look at this. I think now it's probably time for us. Yes, Mr. Deepak.
Yeah, I wanted to add one more strategy to that, more for the individual investors. And that strategy is, do not put all your money only into investments. You also need to have savings. So sometimes when, as investment professionals, we sit down and start discussing investments, we forget that the first part of saving money is putting money in savings. The second part is growing your money. So one way to protect yourself from such volatility is to always ensure you have sufficient savings on the side, and you have a percentage which depends upon your risk taking ability, only that percentage invested in the markets. So however good the stock markets may be, in the long run, you can't put 100% of your money there. So this, according to me, is the best strategy for individuals when it comes to managing volatility and avoiding knee-jerk reactions.
I think that's a great point, especially in this current context, where there's a lot of uncertainty looming around. I think it's high time investors go back, individuals go back to the basics. You start saving first, think of investment second. Okay.
If I may allow also, your question was, how can you protect your portfolio against these things? As a retail investor, the straight answer is you can't. Because even the institutional investor did not see this coming, and when he saw this 30%, you couldn't find a buyer for a share if you had. So don't worry about protecting against these extreme events. But those strategies that Mr. Dr. Qasim and Deepak talked about are there to try to smoothen kind of the damage on the short term, hoping that on the long term, some of those will come back and produce, and therefore you will not get hit all from one place. That's what we try to do, the diversification. But today, as a retail investor or somebody who has, even some of the places they categorize $1 million of investment as high net worth, I think that is, in this market today, is not really so. But if they do that, it is very difficult for you to invest and then go buy options or buy, because some of those are not available even for you as a local investor. And to diversify this over 3 or 4 or 5 strategies, that means there's very small returns, and to try to come out of them all at the same time is difficult. But I agree, the money that you put for investment should not be your full wallet. That's what Deepak was telling, is that so in case it goes down, that doesn't stop you from being able to pay for your food or pay for your rent or pay for your other commitments. And you have to have the ability to take a hit like this for a period of 6 months. If you don't, you probably will get hit, and it'll be very difficult to protect yourself. That's my advice for the individual investor. Institutions is a different story, of course.
Thank you so much for this. I think
something very quick. I think, especially for individual investors, because don't go alone and start to pick stocks and do some exotic investments, because we've seen a lot of people actually losing their shares. If you want to do this, going into options or futures or something which is not the plain vanilla, you have to go with the likes of Muhammad, Deepak, or Qasim to help you with that.
Thank you. I think our participants are very lucky to get this kind of, very honest and, very straightforward advice, where people speak their heart. I think, people are lucky to hear such advice from very seasoned investment professionals. Now, I think it's time for us to look at some of the other asset class, because equity can be an endless discussion, We're getting a lot of questions about one of the sector that's most important for UAE, which is real estate sector. Now, real estate was witnessing a slowdown for the last few years. There's been an instance of excess supply in the market and lowering demand, though at a gradual pace. Now, this COVID disruption has been a real big disruption. You're reading articles saying organizations are preferring to continue work from home. Twitter CEO made a remark that, I can let my employees work the whole lifetime from their homes. See, if work from home becomes a norm, a culture, what would happen to the commercial real estate? What would happen to the residential real estate prices? You're seeing a softening of yields. So I think it's very important to get the perspectives on this, especially from Dubai and from a regional perspective. What is the road ahead for the real estate market? Because many investors in UAE, the single largest asset allocation for them is real estate. Is it time to buy or is it time to stay away? I would be very keen to hear your views, gentlemen. Who would like to come in first?
You choose. I'm happy to come in if you want.
Sure, please.
It's true. Real estate is really at a very tight situation at the moment, whether it is commercial or whether it is residential. And from two fronts. Today, the price of any asset in real estate is dictated a lot of time by the yield it can, how much, so the rent price. With rents going down, that means today that the prices of the units today have become, the returns have become really maybe below 4 or 4% in some cases. And some people who have went and they've financed those kind of purchases of real estate by doing mortgages are really kind of struggling today to be able to balance between the rent and the covering of those kind of mortgages. On the commercial front, it's much lower, and I think it's still work in progress, but there are two areas that to think about. Yes, a lot of people are working from home. However, there is social distance is required to be in the current office. So the current office structures that you have of big spaces, multiple open space for everyone cannot continue now, because going forward, you need to make this two meters between each. So this has to become bigger. So maybe you lose in terms of the kind of the demand on some front, but on the other front, you cannot fit all the people if you want to continue or where you were before. But overall, I think for the UAE, real estate is extremely important, not just because of the individuals who actually have bought it, but also for the banks who have lent against it. And those kind of issues, this balance now, I mean, I don't know if many of you saw what Chairman of Amar, Mohammed Al-Abbar, was in Arabiya a few days back. And he says, he's a bit more optimistic than before, but he still believes it'll take at least 12 months before things to go where they were before the crisis. So there is some time to come before we can see the demand, if you want, increase. I think but people are still trying to, excuse my expression, lick their wounds to try to really see the total damage. They still did not see the total damage till now. That will probably show up once the period that the central bank gave for the banks to give people some time not to pay their the mortgage monthly payments and things like that until we see, and then we can see what happens there. But to talk about increasing prices of real estate without increasing rents is very difficult on the short term.
Thank you. Can we have here the perspectives of the bankers here? We have two bankers, though they're investment professionals and not necessarily credit professionals. So can we hear their perspective about how they look at real estate as an asset class, especially in the region?
Sure.
And, yes.
Sure. Thank you, Dr. Alan. Thank you, Mohammed. I think it's important in real estate. Always we ask ourselves the three important things. It's location, location, location. This is, I think, we have to look into it. If I analyze a little bit the figures, we have the global real estate index worldwide. Year to date, it went down up until last week, minus 15%. And just in 1 week, we recovered between 8 to 10%. This is just if we see it globally in an index, just if you analyze figures. I think the UAE is different than other markets. We have to analyze each of the markets. If we talk about Europe, about the US, about Asia, the UAE is living from frequent tourism visitors out of the country. We received last year more than 25 million visitors. We have not that seen this year, and we will not see this year coming in. And most of the purchases have been done by visitors, has been done also by existing experts, where we lose this year in the UAE. We are a population of approximately 10 million. We will lose approximately 1 to 1.5 million. That will be definitely a reduce of residential and also of commercial businesses. We will see a downtrade of restaurants closing, businesses closing, because we have found out that in these last 2.5 months, we can work excellent also out of home. So the work out of home office strategy will continue, because we have seen even in the banking sector that some businesses have been performed better when the employees working out of home than out of the offices. And then even from commercial side of view, from the banking perspective, I think branches will be reduced. A lot of things will go more into online, and the bank will become more a fin technology company, while a lot of fin technology company will become banks. So here is a huge revolution coming on, and real estate demand will be less in terms of residential for sure in the UAE on the short-term basis. On the commercial side, I think we will have also at least another 3 to 5 years, which will be reduced indeed as well, because businesses are closing simply for less of demand. So somebody who would like to go into the real estate business, he needs to be sure what kind of yield he's expecting on the mid and long-term basis.
Sure. Can we have some other perspectives on this, on the real estate market? Because I think it's a very important asset class for a lot of investors.
Yeah, I can only say that like any other asset class, real estate also depends upon supply and demand. Over the last few years, we have seen a lot of supply coming in and a lot of supply being planned. And that was done with expectations of certain events which will be driving demand and certain extrapolation of business activity. And if that is not happening, or if that gets delayed, then clearly there will be more supply than demand. And if you just go around, you still see a lot of construction happening. So I think it's the supply and demand that we have to be conscious of before deciding whether an asset class can give us the desired returns. Liquidity is another aspect. Liquidity is another aspect in real estate as an asset class. Real estate is not as liquid as stocks are. And so if things don't go well for you and you want to cut your losses and you want to exit even with a 10-20% loss, you don't find liquidity. So these are the elements which we should be conscious of.
So I think it's yes.
Again, I mean, if you think about, if you want to compare, at least say Dubai, because this is where probably a lot of real estate is happening, is mainly in Dubai. If you compare Dubai to some big international cities, Singapore or Paris or Tokyo or London, you will find out very easily that in all the other cities, it is very rare to find a plot to build something. While in Dubai, they are blessed by having a lot of land. So that gives you an idea that supply could be unlimited in Dubai. I mean, they can go and build in the desert if they want. While if you want to build something in Singapore, you have to reclaim the sea, because there is no other place to put a building. And same applies to London, where you have to take down a building to put another one in its place. So people who are looking to invest in real estate, they should take this into consideration as well.
I think that's a very interesting discussion that we had on real estate. So I think the summary of the whole thing is it's better to be prudent. There's no hurry to jump in. I think it's better to wait and watch and see how the market pans out. A quick recovery in real estate prices, a sharp rally is very unlikely, at least in the near term. So I think that's what I could conclude from this discussion. Now we'll have another quick poll about a very interesting asset class, which I think everybody should be having. It's gold. So we would like to hear from you. Is it something that you've been buying? Then I would definitely ask our panelists to seek their opinion. So now, can we have a quick poll on this asset class, gold? We're getting a lot of questions also on gold. So let me put all this together in this discussion. Mr. Phoebe, can we have a quick poll, please?
Yeah, the poll is launched. We have already 40% voting. We will just close it in another 30 seconds. You can continue the discussion on the same, and once it is done, I will message. Thank you.
Sure. So I think it's time for us to look at this very important asset class, which I'm sure as investment advisors, you would always probably advocate your customers to have at least a percentage of your portfolio into this precious metals category. So if you look at gold as an asset class, it often tends to do well or very well or amazingly well when there's bad news in the world. So 2008-9, when we saw the big crash, the next 2 years saw the big bull market in gold. Gold prices went from somewhere close to $800 to $1,800 by 2011-12. Now, is such a time coming? Is it time to go all out and buy gold? There was a long bear market in gold for the last 6 years. Is it over? is it time to go and buy gold? Is my question to you. Can I have your views about gold, and what would you advise the investors? Yes, anyone can come in, please.
I think, yes, please go ahead, Mohammed.
Gold is really a very unique asset in the sense that, if you buy this, it doesn't give you any returns unless it goes up. So if you believe today that this price of gold is going to be higher in a year or 2 or 3 years, and you're willing to wait that without taking any returns, happy for that, then that is one thought process that could help. The other effects that affect gold prices going up is really things like the inflation in the world, if there's inflation or not, the value of money. So today with the printing of the dollar, although we saw the value of the dollar become stronger earlier, but now it's going weaker. If we believe that this is going to continue and the dollar may go weaker, so going into things, commodities like gold could be a good hedge for it. But you have to be careful. It's not a speculative kind of trade. Don't go buying these, some of these exchange houses or some of the brokerages. They will give you leverage 20 times to buy these things. Don't do that, because a movement of $40 at the price of $1,700 is possible, and that could wipe out your capital if you do this leverage. So if you're buying it as a spot, keeping it for the long term, it has proved to be a good holder of value in volatile times. However, it is not a kind of, it doesn't let your adrenaline flow. It doesn't give you this rush when you do a right decision. And there's a lot of other effects around in the economy and in the monetary policies that will affect it. That's my point.
Can I get some other perspectives on this gold? I myself, I'm a big gold bull, at least for the next few years. I don't see a massive economic recovery coming, and it's very likely that, in my view, that gold will do well. Can I have other perspectives on this, please?
Yeah, indeed, Dr. Allen, I would like to give my comment on this one. If we just also analyze quickly a couple of the numbers. In December, we had prices for kilo, for $47,000, which is approximately 1,450 per ounce. And if you look today, we are approximately 15 to 20% up. We have seen a downtrend in the middle of the Corona crisis, which came immediately down and then up again. And the question is why this happened. I think it happened mainly because people looked into an alternative asset class because they are worried about the value of the money. Why? Because a lot of people said, yes, I think the government wants to help economies to go in. Germany came with a big package of 120 billion. The American was 1-2 trillion. But based on what? Do they have the assets? Is my dollar today the same worth or value I have in 10 years? I think gold has been showing, and if we get back 10, 15 years back, we have seen the ounce less than $400-500, and now we already tripled. So I think the long term, an investment class must be in any portfolio. We recommend as bankers to have at least 5% in a gold asset. It is a part of a protection, and we have also to ask our question why most of the central banks are increasing or have increased in the last 3 to 5 years their assets by gold and not by currencies. So I think it is still an asset class to be in for investors who would like to have a part of a protection, and which is also very liquid in case you need an alternative currency in order to go into the markets with cash.
Sure. Thank you so much. Thanks for this, very valuable insights on gold. I think now we can probably, we've been getting questions and have been shooting some of those questions. Now we can open the floor for the audience to ask questions. So can you please type in your questions in the, the Q&A chat? Many of the questions that were asked, I've got a lot of questions. I'm sure, if I ask everything, we'll not conclude even in the next 2-3 hours. We're just running short of time. We have just 15 minutes left. So if you have any pertinent questions to ask, we would be glad to, hear your perspectives. Please type in your questions in the chat window, and I'll, take it and redirect it to the panelists. If you have a specific question for a panelist, please write the name and, put it in the chat window so that I can discuss. Meanwhile, I've had some questions which I think we've not discussed so far, is about the alternative assets. There are a lot of people who are looking at things beyond the normal. So equity, a lot of people saw the blood pressure shooting up like anything in March, seeing the way it crashed. A lot of people said, I would be much better if I could invest in something which is not really liquid, at least in the near term, but could give me a lot of money in the future. So there are a lot of investors who are looking at crowdfunding platforms like venture capital platforms, where you can actually participate in many of the startup growth stories, especially around technology. A lot of very innovative startup companies are coming up in the AI, blockchain, fintech domains and all this. So what is our view on that? I think I'll ask this question to Mr. Mark, Dr. Mark, because he's somebody who follows technology very closely and is an advisor to a lot of tech companies. So Dr. Mark, can I have a quick view about investing in some alternate asset classes, and how can even individual investors, how can we look at investing there?
Yeah, sure. Thank you. I've been working with alternative investments. Myself, I've been in private equity before being actually an investment banker. So I'm full in for alternative investments, and especially if you want to take, again, a long-term view on things. So it's not like equities or bonds or even gold, where you can buy now and sell tomorrow and still make 5–10%. If you want to go into alternative assets, especially private equity or venture capital, you have to be there for a long time, because as probably most people know, that the lifetime of a fund, of a private equity or a VC fund, is between 5 and 10 years. So usually it's around 7, and it could be extended by 1 or 2 more years. So it's really a long-term investment. Having said that, we have seen a lot of people making a lot of money by investing in something like this, but certainly not the small amount. So usually the private equity funds and the VC funds, they are not open to small individual investors. You cannot say, I have $10,000 and then I want to be in KKR or in Carlyle or in Sequoia, which is a massive venture capital fund manager. Either you have to go through feeder funds with some intermediaries, or you have to have a much bigger check to write. And then again, they should give you access to something like this, because they have all the pension funds and all the sovereign funds and the massive family offices on their radar screen, and they've been investing with them for a very long time. So obviously it will not be open to anyone saying, I have $100,000 or even $1 million, or sometimes even $10 million to say, I want to put money with you. So that's, I think that's the main issue with these funds. When it comes to the big players who have access to the best opportunities. So if you are a tech company in Silicon Valley, you will not come to raise money from the Middle East unless there is a very specific angle for you to raise money. You can come raise money probably for some sovereign funds. And Mubadala, for example, in Abu Dhabi, they have been investing in some very good technology companies outside of the region. But you cannot come and say, I want to raise $2 million and then collect 50,000 clips from different people. Yeah. So that's the main issue when you think about the alternative asset class.
Okay, thank you so much for that. I'm having multiple questions, so I'll try to take some of them which are very common, and we'll post it together to the participants. One question is about the bond markets. So what could be the investment strategy there? So what should you do as an investor? Is there any interest rate hedge that is suggested by the panelists here? So can someone take this question about what should the fixed income investors do at this point?
I can take it.
Yes, Mr. Lee.
Okay. I think fixed income is an asset class which is not very well understood by people. They think it's like putting money in a deposit. It is not. Bonds are volatile in price, and bonds are also subject to the credit risk of the issuer of the bond. So I think in times when you are entering into a period, a period of slowdown, and this is a structural issue, not just by COVID, but it's been accelerated by COVID, where the economic growth is likely to be slow and interest rates low for a very long time, not all the companies are likely to do well or survive. So we may see bonds which are giving us very high returns, but it may be very difficult to predict whether that bond issuer will be afloat at the time of the maturity of that bond. So I think it has become even more difficult to invest in bonds because now you have to be very clear about the credit risk you are taking, and you should be able to assess that credit risk. And that is why we are seeing a very large push into investment grade bonds, bonds that are being issued by very large, profitable, sustainable companies or by governments, where the investor is sure that when the bond matures, the issuer of the bond will be there to return his money. And therefore, customers are happy and willing to take lower returns in the case when they are secured with a good quality credit. So I think these are the things to look at in the bond market rather than simply chasing returns once again. Also keep in mind, when you are entering into a slow growth, low inflation world, you do not now have to get returns of 7, 8, or 10%. It's not required. I think we should be happy with returns which are slightly above the risk-free rates. And so the mental mindset of the customers is still saying, can I take leverage? And I think Mohammed Yassin alluded to that. Can I take some leverage on my bonds, increase my return to 10%? I think it's the worst strategy, because you can't assess credit till the maturity of that bond, and you'll now owe double the money. So you can lose double the money. So I think
that's a very, it's a very
with, yes.
Yeah, I think it's a very interesting point that you shared. And I think credit risk on the bond it's a very important factor to look at now. You can't simply follow the yields. You need to look at the quality of the issuer. So it's better to keep your money safe than just go behind returns when it comes to fixed income. So for people who have that risk appetite, I think it's better to be in equity. So at least you know the risk that you're taking. I have more questions. I think I'll go to some of those questions. There's some questions to Mr. Mohammed Yassin, others can also come in, is about what do you think about the UAE economy in general, especially in the second half? Where do you see a recovery? Do you see a recovery soon in the sense in the second half of the year? And others can also pitch in with their points. There are many questions on this topic, so I think I'll take it together. Yeah,
that is an economist question rather than.
Yeah, I think we are better than economists.
I will try to address what I can from my view. Honestly, we need to be honest really here today. Looking forward, I think the government has done what it needs for now to try to quell the first part of the issue, the surprise of the virus. Now we're going into opening up of the economy. And I think once we start to open up the economy, the real issues will start to come up going forward from companies, from businesses, from real estate developers, from contracting companies, where payments and liquidity, it becomes a big issue going forward. We know that the government here has intervened by lowering lots of the fees or taking some off to try to help on the short term. But we have not seen today now a fiscal kind of spending plan that comes in to try to take this, push it for the next 6 to 12 months. I think that is what we need to go forward to. I worry over the second quarter too that we are in now. Going to quarter 3, I'm worried actually into what will be a lot of the impacts, whether it is on the employment, whether it is on the companies staying open, whether it is the ability of those companies to make money in reduced kind of environment. So the challenges are big. You add to it lower oil prices than before COVID. That also will put some kind of pressure on kind of the spending, although we hear the government saying we will continue with most of the major projects, but there's pressure now asking a lot of those vendors to try to lower their prices or to give discounts. So going forward, it's going to be a challenging end of year. We saw the central bank report come out yesterday talking about the contraction in the economy, even some of the tight credit in the second and third quarter, hoping that Q4 we start to recover. So I think to be a very transparent here, I think we are, let's say, I don't want to say we passed the worst and we're going to a better, let's say we are living, we're close to the bottom or where it is, are coming back, going up, growing up. We need some kind of positive steps by the government. I think that may come maybe in Q4, but you need to now, sitting here, you need to try to, I think we should put a time with some of the numbers we've seen and some of the expectations in many of the sectors. I think we should look at more like 12 months as a realistic place where we can go and say we can see a recovery. 2021, hopefully a cure is important for this virus in order for us to see the 2021 now, the expo happening. And if that happened, we could see that kind of setting kind of change. But we have to be very conservative, or I am very conservative in my expectations for the next year.
Yeah. I think that's a very fair view. It's better to be prudent and, careful, take a month at a time, rather than taking a very long-term view. Anyone would like to share their view on this topic? Any other panelists, if you can, you can just chip in. No?
I think just the point, and I'm not sure if Deepak or Qasim mentioned it before, is about the number of people that gonna, unfortunately, being forced to leave the UAE because they've lost their jobs or they've got some salary cuts, or it doesn't make any sense for them to live anymore here because it is more expensive. I think we should all take this into account as well. This will have also a massive impact on the consumer sector. And that will, of course, if you have 1 or 1.5 million people less in the country, this is 1.5 million people eating less and dressing less, and not all of them will send kids to school, but again, the schools will be affected, the hospitals, the retail shops, the restaurant, and it will snowball. So that will have a massive impact, negative, unfortunately, on the recovery.
Thank you for this point. And I think one can be hopeful that things could get better from here. And the world learns to live with the virus, and things get back to normal. I'll take another 2-3 questions before we wind up, because we are really running short of time. There's one question, actually few questions on one of the asset class that we never touched about so far, the cryptocurrencies. I know it's probably something that we shouldn't advocate on this kind of a platform, but there are a lot of curious investors. We saw the Bitcoin crashing from 20,000 to 80% down from there. A lot of people now say, is it time to even look at those? It's not for all. It's for the highest risk takers in the market. Since there are some questions, if any of the panelists would love to take a response on this, I'll be glad to share it with the participants. Yes.
My 2 cents on it.
Yes.
Run to the hills. It's not, there is, I cannot see any social use of a cryptocurrency like Bitcoin or any other cryptocurrency. It's still, too much volatile, and it's not for investors.
Yes. Any other views?
I fully agree, and I think absolutely correct. This is, in different times in history, people have found different things to speculate on, from tulip bulbs to all sorts of strange things, to Beanie Babies in the late 90s and so on. So there are always things which are available to speculate on. Calling it a currency is a misnomer. It is no way can it classify as a currency something that cannot hold its value and fluctuates 80% up and down. So I think it's completely to be ignored by investors, and the technology behind it may be very useful and may become very effective in managing many processes in the future, which is blockchain. But cryptocurrency has no role in the society, as Mark absolutely correctly stated.
Thank you.
Sorry, but
Indeed.
I agree with both. Sorry, Qasim, do you want to say something, sir?
Yeah, indeed. And I have to say that as a banker, we all get a lot of those questions as well. First of all, to make transactions in virtual currencies, cryptocurrencies, are in the UAE regulated, and they are strictly not allowed and prohibited. It's written in the Library of Congress under the Article 7.3 of the regulatory framework. And I think it's very clear it is not allowed to deal in the UAE with cryptocurrencies.
I'll just be a bit here. I agree with all of this. All of this is really, you're buying, if you buy cryptocurrency or Bitcoin, as it was told, the numbers you said, Dr. Allen, you're buying wishful thinking. But I will say something. The fact that this have come has pushed many of central banks and many banks to try to think outside the box of how to make this kind of currency FEMA accepted, so it becomes like a part of it has part of the monetary system. So I would not be surprised if in the next 2-3 years we saw things which come issued by central banks or by a consortium of central banks to be a digital currency. Because and it's something we've learned from this COVID-19 crisis is people who became more using this digital payment. And there is a need for this as a currency, but to be with underlying support by some government or some central bank country to protect it, but not the way we see it at the moment.
Sure. So I think, it's a unanimous advice, stay away from cryptocurrencies. It's good to read about it. It's good to just check the prices once in a while, just out of curiosity, but it's not probably the place to put your hard-earned money on. So since we are really running short of time, we would like to conclude this very interesting discussion. We have many questions and we can go on endlessly. So as I conclude, I would ask each of my panelists to take a minute and share the last few words, as to what is the outlook and, how do they look up on things. So can I have each of you sharing your quick views in a minute? We are really short of time. So yes, please. Yes, Dr. Mark, you can start. Yes.
I'll start. So yeah, I think my comment would take us back to probably to the first question that you have asked about the economy, about the equity markets, about the liquidity, and so on. So I think that definitely there is, with the Fed splashing money into the market from end of March until now, the balance sheet of the Fed has increased by $3 trillion. That has translated automatically into increase in the S&P market cap of $2.8 trillion. So all the money is gone from the Fed to the equity capital markets. So that's create a very high correlation between the Fed balance sheet and the equity capital markets. At the same time, the correlation between the real economy and the S&P or the equity capital markets is close to zero. So if you want to know what is going on in the equity capital markets, don't look at the real economy, look at what the Fed is doing and how much they are injecting money into the cycle.
Thank you. Yes, Mr. Mohammad Yassin, can you comment with your final remarks? Yes.
I'll just say, but the question of our webinar is how to invest post-COVID-19. And I think the answer is, yes, you do invest, you invest wisely. I would say today, nothing has changed in the sense of now, if you look at markets, if you missed the last 3 months and you came back, you would not see anything. Markets are nearly where they were. But I think so my advice to people is to try to buy on dips. Wait for a dip to buy into. Don't run after the market now at these levels. I find it a bit on the high side and a bit on the more optimistic side. It's pricing a bright future, which I think is not pricing some of the hiccups on the road. We will definitely recover and economies will go back up, but that will take time. Wait for a dip and then go slowly.
Thank you. Very interesting points. Dr. Qasim?
I think I would like to make it short. Let's discuss risk profile. Let's discuss the way the customer would like to invest or the person who would like to invest. I think every recession, every market disturbance have also alternatives and possibilities to give a good performance, and we just have to grab the right way, the right channel and the right markets. And there are always opportunities in good and in bad days. I thank everyone. Thank you, Dr. Alan, Mohammed, Mark, and Deepak, and my friend Phoebe for participating today with you together.
Okay. Mr. Deepak, your last words. Thank you, Dr. Qasim.
Yeah, I would like to echo everything my fellow panelists have said, except last one line that I would like to say is, well, we have had these mega trends which are playing out, and there's nothing that has changed because of COVID except they have become faster. So we are entering into a world which will be low growth, low inflation, low interest rate. In these times, return of capital becomes more important than return on capital. And that is the last thought I'll leave everyone with.
Good point.
Thank you, Mr. Deepak, for that. And